Wall Street, right? It usually feels like this giant fortress full of confusing terminology and flashing red and green tickers. But honestly, if we just strip all of that away, the entire market is really built on one absolutely crucial divide. We're talking about the profound difference between trading and investing. Let's jump right into this explainer and build a clear framework together. Okay, let's dive into this. Gambling or wealth building? When you picture Wall Street in your head, do you see a chaotic casino? People rolling the dice, hoping for that overnight jackpot? Or do you see a methodical engine designed for steady, generational wealth? Answering that question is actually vital. Why? Because your psychological perspective completely dictates how you're going to approach the market and ultimately your own financial future. So, to cut through the financial industry's absolute obsession with complex jargon, we're applying a strict ELI 5 framework today. Explain like I'm 5. By just leaving all those intimidating math formulas right at the door, we can focus entirely on the actual mechanics operating behind the curtain. We're looking past all the noise to see how capital is actually transferred and, more importantly, how it grows. And that brings us to a core dichotomy. Wall Street essentially operates in two completely contrasting modes: the sprint, which is trading, and the marathon, which is investing. And listen, these aren't just minor tactical shifts. They are entirely different psychological mindsets. They operate on vastly different timelines, and they have completely different mathematical goals. So let's break down each side, starting with the sprint. Section 1. The trading sprint. Chasing the market. Imagine the pacing of a literal 100-meter sprint. It's frantic, it's high stress, and it requires your absolute maximum energy. That is the day trader's world. Step 1, you're glued to charts. Step 2, you are literally sweating over split-second decisions. Step 3, you're attempting the near impossible task of timing the market perfectly. And step 4, you're just chasing that quick cash. It's this relentless environment where you're essentially gambling against high-frequency computer algorithms. And, considering studies consistently show that over 90% of active day traders end up losing money, well, you're basically hoping to beat a system that is mathematically stacked against you before you completely run out of breath. Section 2. The investing marathon. Patience and sleep. Okay, take a deep breath with me. We are stepping off the track now. In striking contrast to the sprint, the marathon requires endurance, not speed. Now, what's really interesting about this slide is just how simple the steps are. Step 1, you buy a tiny slice of a functioning business. Step 2, you go to sleep. Literally. I know it sounds almost too simple to be true, but removing yourself from the daily panic and just letting the company do the work for you, that is statistically one of the most robust strategies in existence. Sometimes, doing absolutely nothing is actually the most powerful financial move you can make. Section 3. Demystifying the magic. Compound growth. So, if investing is really as passive as sleeping, how does it actually build wealth? Well, the answer isn't magic. It's the mathematical reality of compound growth. So the crucial point is, there are no crystal balls here, no secret formulas. You're simply allowing the profits generated by your capital to begin generating their own profits, completely free from any mystical intervention. It's just a straightforward exchange of capital today for amplified capital in the future. Let's move to and see how this builds across a timeline. In year 1, you buy that initial slice. By year 10, compound growth is quietly turning the gears. By year 20, wow, that growth accelerates exponentially. Think of the rule of 72. Your money is doubled, it's made more money, and now those new dollars are working just as hard for you. By year 30, the math has done all the heavy lifting. The patient investor basically just slept, while this mathematical marathon built massive, undeniable value. And this brilliantly illustrates the ultimate divide. On one side, sweating over charts, fighting this relentless anxiety, and chasing quick cash in an absolutely exhausting sprint. Versus, on the other side, sleeping soundly, completely removed from the daily noise, while compound growth quietly scales a mountain over decades. It just perfectly encapsulates the stark difference between a high-stress gamble and a patient, calculated marathon. Which brings us to the most essential question of all. Which race are you running? Are you lacing up your shoes for a frantic sprint, just hoping to outsmart algorithms for a quick payout? Or are you preparing for the marathon, letting time and compound growth do the heavy lifting for you? Look, the market offers both paths, for sure, but only one of them leads to wealth without the sweat. You have to decide how you want to run your race. Thanks so much for joining this explainer, and I'll catch you next time.